Welcome back to Power Lunch, everybody. In our Market Navigator segment, as we mentioned, the markets are pushing higher today. We've done a lot of volatility hedging ideas lately, but what if there was one stock that could serve your portfolio as both an offensive and a defensive play? Carter Worth of Worth Charting joins us now. Your idea, Carter, is to buy Berkshire Hathaway B shares. How does this sort of go both ways in a portfolio?
Yeah. Well, before we look at the charts, one thing we know is, of course, year to date, it's been quite a happy outcome in the sense that both the S&P and the QQQ up 15, 16%, and Berkshire up 23. So doing its job both offensively and defensively, less of a drawdown. But let's look at two charts. They're both identical with different annotations that speak to the current situation. We know from its lows of October of a year ago, it surged from 330 to 430. You see that annotated there. And it's been range bound the past 6 months since that February high, but just now is starting to move out of the range breakout. A second chart, same chart, but just different, a way to draw the lines. Whether you want to call this an ascending triangle. People like to name their patterns. It's not about what you call it. It's typically resolved as follows. After a strong advance, 330 to 430, a 30% move, and then a very pronounced consolidation, the standoff is usually resolved in the direction of the preceding advance. And so the breakout here that's underway, I think, carries quite a bit further. Tyler, final chart that might be informative and instructive. This is a ratio chart, which is to say it's one thing divided by another, and it produces a relative strength line. And so that line is simply Berkshire divided by the S&P. And of course, what you see is that Berkshire's relative performance, the market peak in the dot-com was at a low. No one wanted Berkshire, they wanted Cisco, most valuable company in the world. Of course, it was right to do the exact opposite. And then you see the peak in the chart, which was a financial crisis low. Everyone was throwing everything away, and of course, they were hiding in Berkshire. So Berkshire's peak performance to the market actually goes all the way back to the financial crisis. It's never exceeded that relative high. We think ultimately Berkshire will make new relative highs to the market, offering both an offensive and defensive trade.
So if I'm understanding you correctly here, Carter, we looked in those first couple of charts at a stock that is breaking higher relative to its prior, right? Breaking higher. And in that last chart, what we saw was a stock that does better relative to the S&P in times of stress.
Well, essentially, that's right. It's a defensive trade, but with one, I look at year to date, it's outperforming the market. If one likes the cyclicality of Berkshire, which it has, it's obviously tied very much to financials, but it's also a big railroad. It has a lot of consumer brands. We think it, again, because of the cash holding, which is not a technical thing, that's fundamentals, because of the person in charge, I think you get both sides of the coin here.
All right. Carter, thank you very much. Great to see you, my friend.